So today's speakers, we have Ben Firestone, Alan Plush, and Beth Mace. Ben is a founding partner and senior managing director at Blueprint Healthcare Real Estate Advisors, a leading advisory firm exclusively focused on seniors housing and healthcare real estate. Alan serves as the CEO of Health Trust and has specialized exclusively in healthcare and retirement valuations for 30 years. He has extensive experience in the appraisal of nursing homes, senior housing, CCRCs, hospitals, and medical office buildings. And Beth is the chief economist and director of capital markets research at the National Investment Center for Senior Housing and Care Industry, the NIC. So with that, I'm going to turn it over to Beth to get started, and we'll just move from Beth to Alan to Ben, and then we'll do some Q&A after that. Thank you again for joining us today.
Hello, welcome. Full house. You can keep this interactive, so if there's questions that come along that you have, you can certainly raise your hands and we'll try to address them as we go through. I'm going to start and sort of lay the groundwork for valuations from my point of view. I'm an economist, so I'm going to give you a little bit of economics because that's what I really like to do. And just to lay that in terms of how it fits into valuations. So factors influencing seniors housing and care valuations. Well, for seniors housing, there's really two components that create the value for a property. And it would be the real estate component. So that's the physical asset itself, the bricks and mortar, so to speak. And the market fundamentals around that bricks and mortar really help determine the valuation. So the market fundamentals would include supply, demand, the demographic characteristics, the number of seniors that are in the market, the number of adult children in the market. Those are all going to affect the physical valuation that goes into an appraisal for a property. But importantly, and yes, a theme that you're hearing here at NIC recently, is really we're looking more importantly at the operating company component of evaluation as well. And that's looking at the business enterprise value, the operations, who's running it, what's the operator, what's the characteristics of that operator, what kind of capital structure was done in the deal, what's the exit strategy for that property, what's the business model, what's the resident mix. So all of those factors are going into the valuations, and this is what the rest of the panel will be talking about. It also includes sort of the broad property characteristics as well as the broader environment is really helping to determine what the value is. So that would include, and I'm going to talk about these more specifically, what's going on in the national economy, what's going on in the local economy, and that's going to affect the demand drivers. So if you think about seniors housing, the demand drivers are the adult children and the residents that are in the area. So the local economy affects clearly the adult children and whether they are employed or unemployed. We look at the industry mix. If you're in a market like a San Francisco versus a market like Detroit, those are different industry economic drivers that affect those markets, and that will in turn affect the employment of the adult children. Capital market conditions, that clearly affects the availability of capital, the availability of the equity, the availability of debt capital, and also its pricing. So with the higher interest rate environment that we're moving into, that has potential to affect valuations because of the impact that it could have on cap rates. There's a perception of the asset type risk and the premium placed on it. If you look at what the cap rates for seniors housing are, depending on the source, it can be anywhere from 6 to 8%. For apartments, it could be 4 to 5, 6%. If you look at the risk premium, that's the definition of the cap rate difference to the 10-year treasury. The risk premium for seniors housing is considerably wider, 100 to 300 basis points wider, depending on where you are. That's going to affect the valuation when appraisers do look at the market and look at the specific property. What's the influence, again, of the enterprise and the operator influence? How is it priced relative to other assets? And often the pricing will be changed whether it's a part of a portfolio or whether it's a single asset sale, and our panel can speak to that as well. So as background, when you look at the valuation of a property, you really need to take into context what the supply and demand for market fundamentals are. And this is a slide that demonstrates that. And this is looking at NIC has what we call our primary markets, which are the largest 31 markets in the U.S. And this is showing the pattern of occupancy over time since 2006 till today. And this occupancy level, you can see, was about, on the right-hand scale, was about 92%. Back in this day, it fell to about 86%, and today it's about 88%. And that's a function of what was really going on in the capital markets, and that in turn affected valuations. So if you go back to this period of time in the 08-09 period during the recession, Just before we hit recession, if you were in the industry, you remember there was a lot of capital available. Cost of debt was really cheap. The cost of capital was cheap. A lot of money came flooding into the system, and that resulted, that resulted in all this blue bar here, which is the inventory growth. Then came the recession just at the same time that there was a lot of inventory coming into the market. Demand got really weak because of the recession, so the occupancy rates came down. If you follow the blue bar here, there was very little inventory for a number of years, and by 2017, sort of that pent-up need for creating new supply got created in the 16 and 17 period, and to the point that in the second quarter of 2017, we had a record amount of new supply brought into the market. Now, I don't have the slide here for assisted living, but you'd see the same pattern, except the occupancy rate would be a little bit lower. And in addition to seeing record amount of supply that came in the second quarter, there was also a record amount of absorption in the second quarter. So there's a significant supply story going on right now, but there's also a significant part of the story, which is demand. So both supply and demand for assisted living were at record highs in the second quarter. Demand was strong, it just wasn't strong enough. And as a result of that, the occupancy rate fell. So for underwriting, for doing a deal, for doing an appraisal, for doing the valuation, we want to also look carefully at what the rent growth is. The rent growth is going to help as sort of a proxy for what we're going to see for revenue growth. And then we want to look at the expense growth. And where we don't have the data right now through NIC, although we're working on it, to collect specific property level P&L statements, this serves as a proxy for that right now by looking at the rent growth compared to average hourly earnings, in this case for assisted living. So the green line here is assisted living, average hourly earnings. You can see most recently it was about 4%. And if you look at the trend, we've seen that expenses, as measured by average hourly earnings, have in fact been higher than what we're seeing in rent growth, which are these other two numbers for both assisted living and independent living. Compare that to this period when the green line, the expense growth was less. And that's what we're seeing. If you talk to any operator here, they're going to tell you that they're getting additional pressure on wage rates right now, significant pressure, because the labor markets are so tight, and that's pushing it up, and there's going to be a lot of squeeze on NOIs as we go forward, because rent growth in some instances is not keeping up with that. So that's sort of the senior housing market fundamentals really quickly. Let's look at what's going on in the broader market. So for our sector and for valuations, it's really important to pay attention to interest rates. The Federal Reserve controls interest rates, at least on the short end of the yield curve. This is a chart from the Federal Reserve Board of Chicago, and it sort of is a really good picture of what the Fed's mandated to do. They have a dual mandate. They're required to keep basically a full employment, to keep everybody gainfully employed as well as they can, in addition to keeping inflation at a moderate level. So right now, their goal they measure that by the unemployment rate, and the goal for the unemployment rate right now is about 4.7%. It's below that. It's about 4.3% as of the most recent data that we have from the BLS. Inflation, which is on this axis, their target is 2%. Well, it's coming in at about 1.5%. So they're not close to the quote, the bullseye of what they're trying to do. So they need to continue to manipulate monetary policy to try to get the interest, to try to get these two measures, full employment and inflation, at the right targets. So they're doing that by adjusting interest rates. And last week they also announced that they're doing that by adjusting and shrinking the Federal Reserve balance sheet, which was bloated from all the quantitative easing that had been done in the last 5 or 6 years. So another way to look at this, putting it in one picture, is the red line here represents the 10-year Treasury rate, Fed funds rate. And back in the 2007 period, this is over here on this scale, it was about 5%. During the recession, they dropped that interest rate, you may recall, to 0. It stayed 0 almost 7 years. So if you're a young person in this audience who's new to the sector, you probably only know in a world of 0% interest rates. But I'm here to tell you that it used to be a lot higher, and it used to be a lot higher than 5% as well. So what we're seeing now, the Fed is sort of normalizing interest rates again. And in the last year and a half, they've increased interest rates about 125 basis points to be about 1.25 percentage points. It's expected, the Fed has said that they're expecting to increase rates another 25 basis points this year, and another full percentage point next year to probably bring us up to a Fed funds rate of 2.5% to 3%, which by historical standards, if you look back here again at 5%, that's still low. But that's going to have an impact on the cost of capital, and it will ultimately affect the valuations that we'll be talking about. And then for context here, again, I talked to you about the dual mandate of looking at the unemployment rate as well as the inflation rate, and this is showing a history of that. So the gray line here is something called the core price deflator. It's an inflation indicator that the Fed pays attention to. And again, they're looking for 2%, and we have it at about 1.5%. So it's below that target, and it's been below that for some time. The unemployment rate is on this scale. At its worst was 10% during the peak of the recession, and now, as I said, it's about 4.5%. So they're not quite where they want to be in terms of the mandate that the Fed has. And this translates then into the yield curve. And the yield curve is looking at the maturity length of U.S. Treasuries with the 3-month yield of Treasury down here and the longer-term securities up here. And you can see this has been the impact of what the Fed's already done in the last year and a half of increasing interest rates, effectively flattening out that yield curve and over time. The 10-year Treasury, so if you're looking at valuations, you look at both the short-term rates, because that's what you're going to cue the LIBOR rate off of, and that's what a lot of finances are done off of, and also the 10-year Treasury, because that's more of a longer-term gauge and index for pricing debt. The long-term end of the yield curve hasn't risen as much, in large part because it's controlled by the market, and the market doesn't quite really believe what the Fed is doing. So there's this disconnect right now of what's going on in the markets and what the Federal Reserve is doing, and it's resulting in a flatter yield curve. And that's going to affect the valuation environment as well. So transaction volumes. The cost of capital, you can see in the price of the real estate, can be reflected in the demand and supply for transactions. And this chart depicts, this is data that NIC collects along with the Real Capital Analytics. And it shows the transaction volumes over time, starting in 2008. The color of the bar here represents who's buying. So the red bar is public sector, so that's largely the REITs. The green bar here is the private sector, and then the institutional is the orange bar. So the orange bar would be like the private equity groups. And we had the huge amount of volume in 2011. It's come down. And year to date, we're at about $6.6 billion. But notice that the share of red in these bars has gotten much smaller. So what we saw is that the REITs were very active in the market in the 2015 and 2014 periods of time. They did huge transactions. Now, for a few reasons, the REITs are a little bit less active, in part because the pricing is quite dear for a lot of real estate, and they've decided it's too dear in some cases, in part because they're absorbing all that product that they brought online in the last few years, and in part their cost of capital has changed. So we've seen private equity come back in, and in the first half of the year, Blackstone was very active. They were involved with over $2 billion a deal. They're private equity. So there's a substitution going on here in terms of who's active in the market. And that's going to also feed into what the valuations that we're looking at. And this is a chart that just shows you what the price, on a per unit basis, what the price is for seniors housing versus the price for nursing care. And in the second quarter, the average price for a senior housing property was about $170,000. It's much higher as you go to the West Coast. You can get up to properties that are valued at $450,000 or $500,000 a unit, or even more. And it can be lower in other parts of the country. So, despite the change that we've seen in the buyer mix, the level of pricing has still stayed pretty strong. We're kind of close to where we were for peak pricing for seniors housing. And just for comparison purposes, I know there's a number of you that don't just invest in seniors housing, but you invest in other property types as well. So this is just a comparison to look at other property types. So in this chart, I showed, again, that pricing was, relatively close to where it was for peak. And in this chart, you can see that in the case of offices, for example, they're about 60% above their prior peak. So that's just for some context. If you look at apartments, they're about 38% above their prior peak. And here we go, retail, non-major markets, they still haven't gotten back to their peak. So just for context of where senior housing is, we're about back again at peak compared to the other property types which are less so. Okay, lots of talks about cap rates, and this is data that's from cap rates, not from the brokers and the appraisers. This is data that's coming from NCREIF, which is an organization that's tracking investment returns and pricing for all commercial real estate. So I put on here 3 different property types: seniors housing, apartments, and then all properties in general. The blue line here represents that cap rate for seniors housing. That blip that we saw, this is the first quarter, 17. That blip actually for the second quarter has come back down. So I'll have to wait to see if that meant anything or if that was sort of a one-time aberration. But the important point to take away is that risk premium concept that I brought up initially. Because the risk premium, if you look at the difference between the blue line and these other lines, which is looking at the difference between the cap rates of the valuations of apartments versus seniors housing, that's about 150 basis points different. So there's argument about whether that 150 basis point difference should in fact be 150 basis points, or if it should be higher or if it should be smaller. The senior housing has an operational component, as I talked about, in its valuation. So maybe that's an inherent risk in senior housing that doesn't exist in the other property types, and one could argue that there should be a risk premium. On the other hand, you could argue that that risk premium is too wide in seniors housing and it should be narrower, and our panel will talk about that as well. So this just gives you a little bit of context. And then my last slide is I just want to point out that we're always talking about demographics, and this is a good chart to keep in mind where we are in terms of demographics, because there's a lot of arguments of, are we close, are we far, where's the demographics, where are the baby boomers? So this is a pretty simple chart. It just shows the number of people that were born from 1909 until today, and this is the blue area here is the greatest generation, the silent generation, the baby boomers, and the Generation X, and it goes on. And where we are today is right here. So those people that were born in 1935 are 82 today. So that, if you look at this chart, that point is at the nadir, or the low point of this whole spectrum. So we're just about past that low point. And going forward, you can see it starts to accelerate. So the number of people that were born, so the age that most people are in senior housing when they move in is about 82 to 84. So that's why we're using 82 here, and you can see it starts to grow. But it doesn't really hit the baby boomers, which we've all been talking about. The baby boomers don't get to being that 82 years old in the next several years. It's still a ways off. So I just put that up. It's a good chart to just keep us leveled on the playing field in terms of what we're talking about with the demographics, where we are and when that group is coming to us. And I think with that, I'll pass it on to Alan. Thank you for your attention.
There's the big green button.
Yeah, that's
thanks. Where all this, oops, that's a little bit loud. Where all this fits into from a practical standpoint, Beth touched on a lot of topics that we actually do take into consideration. Cost of capital is a huge component, I think, and it's what's sustained. An artificially low cost of capital has sustained values at the levels that they've been at for a while. I've been kind of calling a market top for 2 or 3 years now, and sooner or later I'll be right. But so valuation can get challenging in a situation like this. We've seen a lot of consolidation. We've also seen like a bifurcation in the asset class. So you'll have good performers, better performers, high margin, low margin. And I'm talking primarily independent living, assisted living, and memory care facilities right now. So Ben's going to touch on more on nursing. But and I think valuation, got a few case studies I'm going to present, but before, and the good news is I'm sparing everybody, because back in the day, I would start by discussing the cost approach and the market approach and the income approach, and we go through all the nuances of that. So I've got 9 minutes today. You're spared of that, but I will try to give you some highlights. And valuation, really, I find that, most people in the audience, they really think of net income and a cap rate as valuation. And that's really predominantly correct. We do 3 approaches, but of all the approaches, really the income approach is the one that I put the most weight on. So there is no one single cap rate, and the 2 case studies I'm going to show give you an illustration of the challenges of just applying a cap rate to an income. But one of the things I want to clear up first is a cap rate implies the income stream goes into perpetuity. And so when you use that rate, you're assuming, so you can't use a cap rate on a non-stabilized income stream. We also use a cap rate is extracted from the buyer's expectation of net income divided into the purchase price, not the current trailing 12, trailing 3 annualized, trailing 1 annualized, whatever. But I'm going to illustrate that with these case studies. So the first one is, and also we subtract management fees and reserves from that. So there's a standard methodology for extracting cap rate, and there has to be a standard methodology for applying one. The nuances are always what's the correct rate and what's the correct net income to apply it to. So the first one, and everyone who has the app, I have it, but I won't be using it. But get ready because we're going to have some real quick questions. So the first one is a 4-year-old building, and you're going to pick up some key points as I kind of describe this. I would call it a second-tier market, but a large urban area. Recently achieved market occupancy of 92%, 4 years old. So it's 100% private pay. It's a new build, so it's nice. The average age of other facilities in the PMA is 25 years. $300,000 average housing value, and a strong operator in place. So if you look at under operating performance, you can see then the downside is we've got new competition entering the market, and let's see, yeah, and it's a kind of the ability to increase rates is thus going to be questionable. So we entered into this. So we had appraised this property for 3 years in a row. 3 or 4. And if you look at the operating statistics, the prior year, you look at net income of $2.1 million, year-to-date trailing 8, annualized, $2.5 million, trailing 3 annualized, because of course we're burning off the rent concessions. So that number keeps going up, 2.7, and then the buyer's pro forma, 3.1 million. So if you look between the prior year and the T8, or let's just take T3 to pro forma is a 15% increase. Trailing 8 to pro forma is a 24% increase. So this is the things that we wrestle with. So that's it, when we're doing valuation. So that's the picture. Now I don't know how I'm going to wing it. And polling question. We're just going to give you like 15 seconds. Just if you have the app and you're ready. So of the 3 questions, what do we cap? The pro forma? Do we cap trailing 3 annualized at 2.7 million, or year-to-date trailing 8 annualized at 2.6? 3 votes? Wow. Maybe why don't I pull my phone out? I'm going to vote too then in that case. Okay. Well, interestingly, so we'll move through these real quick. What? Yeah, just do a show of hands, because obviously the app it befuddles people like it does me. So, okay, the next one is what cap rate would you use? Sub 6. Show of hands. Nope. 6 to 7. Good. 7 plus. Good. Okay. And correct answer is 6 to 7, and I'll show you why. So, final question is true, false. Property sold for $51 million. True. False. Everyone's undecided. You got to vote. This is like, make sure everyone's awake out there. Well, so it sold for $51 million. It was based on a pro forma of EBITDAR of $3.1 million. The cap rate implied on that was 6.08%. And if you look at the trailing 3 annualized, it implied a cap rate of 5.3%. The correct and this is a challenging one for us, and that's why I chose it, because I could put up a normal property that's been operating stable for years, and it's really not that difficult. These are the sticky ones that we have to really synthesize. So if you look on the left, you'll see like property actively marketed. That's a key, because if it was a limited auction, in this case the buyer pool was institutional. There were a number of rounds, and the ultimate buyer had beat out the other. I guess there were probably 2 or 3 institutional buyers. So you can look at the replacement cost as a question mark, and in this market right now, that seems to be secondary. It's not really it doesn't anchor value. It's ultimately the economic drivers. The buyer said that buying a new asset that was stabilized, in spite of all of these other considerations, was more important to them than the other risk factors. So they essentially paid for, I wouldn't call it it's a non-barrier to entry market, but it was a new property, and that had just hit stabilized occupancy. So our valuation was a lot lower than that. Not a lot lower, but when we first took a pass at it, and I was surprised about the economics of the sale. Okay, next. So this is another, I call it sticky wicket, and I got to go fast now because I'm using up too much time. So this one was built in 2011. It stabilized. It sold for $19.1 million. And then 3 years later, we were asked to appraise it for the owner for internal valuation reporting. And if you look at the operating income on the bottom left, 2013, you see 900,000, goes up in 2014 to 1.1 million. It drops to 700 in 2015. In 2016, year to date, 700,000. So this again is a challenge because we'll have a lot of people. A lot of lenders will want us just to use what cap rate or what rate, what income do you cap? And there's a propensity to want to just use the in place. And I disagree with that because ultimately if the market's going to improve, you have to factor that into your valuation. You can see 3 years later in the local right, 80% occupancy and 6 properties in the pipeline representing a 53% increase in the existing PMA supply. 87% occupancy. So real quickly, show of hands, what NOI do you cap? And we'll start with, so the 2015, 2016, 700,000 is the current stabilized net income. Yes or no? Okay. 2014, the income at the prior sale? Good, that was a trick question. And then something else. Well, the answer is something else. You have to, we'll get to this, but something else needs to be, we use a discounted cash flow. We don't just cap NOI in place. So in this case, we would use a DCF to estimate when that property is going to achieve stabilization, 3 years, 5 years out, when that market achieves stabilization. Next question is cap rate, sub 6. Good. 6 to 7. 7 plus. I think, yeah. And then the property's value dropped by, from the prior sale. Number 1, 10% or less than 10. Nope. Number 2, 10 to 20. And then number 3, over 20. And I think a lot of that depends upon the market, the perception in the market and where we're at a given time. So what the buyer, what the property or acquirer's appetite is. So in this case, we use discounted cash flow analysis, and you can see using an implied cap rate of EBITDA of $1,065,000, which is above the current run rate, but below what it would be in if you on a truly stabilized basis, and a cap rate of 6.7%. But the main thing to understand in that case is you can't oversimplify and just put a cap rate on an income stream. You really have to think it through. I've used 2.7 seconds of more, or 2 minutes and 7 seconds of Ben's time, so I'm going to turn it over to Ben.
Thank you. All right. Good afternoon, ladies and gentlemen. So Alan mentioned several different ways to look at a transaction. Hang on a second here. The different methods of valuing a property. As a market maker, what we do in the marketplace, our definition, our position on valuation is what a buyer's willingness to pay is. So the market eventually speaks, and that's how we determine value. But all these different buyers and reviewers, investors, prospects have their various ways of valuing assets. So we're going to walk through 2 cases very briefly, and walk through 2 cases very briefly. We can look at the assets in consideration and then make our assessment of what the market would speak and say and determine what the value would be. So, case number 1, it's the Steelers SNF portfolio. It's the fall, so we do a little football motif here. You got 3 skilled nursing facilities in and around Pittsburgh, 470 total beds, older communities, 2 buildings are operating on a stabilized level. 1 is what we'd call a turnaround or cash flow neutral operating asset. So you see the numbers in the bottom. Le'Veon Bell stabilized, doing about $2.1 million in EBITDA and operating at a 14% margin. Antonio Brown is struggling, puttering along right at about break even though he's having a good year. And then Big Ben, you'll see, is doing about $1.2 million in EBITDA, operating at a 12% margin. Overall, the portfolio is doing $3.3 million in EBITDA, and it's operating at a 9% margin, which is relatively healthy in terms of portfolios. So what are the value drivers? We would say that the 9% operating margin is financeable, so that allows people to tap the debt markets for capital. I think Beth touched on it a little bit. There's a portfolio premium in play here. This is a package that'd be well suited for a regional operator, and there's some serious upside opportunities here too. So that would lend us to believe that the pro forma income would be greater than the trailing income. And the question that the market has to determine is, what are they willing to pay for that future upside potential in the operating cash flow? So how we looked at Steelers. First, we looked at what the market would determine the appropriate metric. Is it a cap rate deal? Is it a price per bed deal? What window do we evaluate? Do we look at trailing, like Alan said? Do we look at future? Do we look at some combination? Do we look at trending? And going back to what metric to apply, the question we raise here is there one appropriate metric for the 2 stabilized buildings and maybe another for the turnaround asset? Other things, just market forces, the spirit of the market. We find that the competitive nature of a bidding process often yields marginal value in a transaction. So this is an attractive, sizable opportunity. We think it'll be attracting many bidders. And the execution risk here is quantified in different ways by different reviewers. So how we felt the market would react here, we came up with a $40 million valuation. That's $85 per bed, which is supported by precedent sales. The application of a forward-looking cap rate on projected overall portfolio EBITDA. We felt that the market would think it was attractive given the scale and the size. And then a cap rate on today's EBITDA is supportive, again, financeable, but the buyers would say there's a price per bed floor on the one turnaround asset and cap the income of the others on a trailing basis. Next case study, Texans Seniors Housing Community. This is a single asset in suburban Houston. In the seniors housing, the private pay markets, new supply is a growing concern, obviously, when it comes to valuation. But this is a new construction Class A building in a growing pocket corridor of Houston. 100% private pay, but the asset is still in lease-up, which clearly there's not going to be historical cash flow on a trailing basis to cap. So how do we look at value? Well, the market's going to look at a hold period, varying different amounts or time horizons where you'd hold the investment. But we took a 5-year model and we projected out a lease-up assumption schedule. The occupancy goes up every year. You'll see in the bottom left corner there. Revenue is going to go up every year, as will expenses, operating expenses. But EBITDA will also go up, and you'll see that the margin scales up as well over time. We projected a investor hold period for 5 years, and they would sell subsequently in year 5. Value drivers here, strong demographics. Beth touched on that. Growing demographics, penetration rates in Houston, all the things you get out of NIC MAP. Age income qualified seniors are strong, and housing values are strong in the market. And then if you look at local supply here in this market, this is a pretty strong, as of the second quarter at least, and I think we've seen that occupancy actually went down in this market because of new supply, but pretty strong overall market occupancy for stabilized assets, which would indicate that you can fill this thing up. So the question the market has to determine, do we buy the story? Is this going to fill up? Can we pay something today that's not supported by the cash flow in place? So how the market looked at this, like Alan said, a discounted cash flow exercise, precedent-setting sales. There's no operating history. We had to make some assumptions and build a model. We found that investors would really look favorably on the lease-up risk here because of what's going on in the local marketplace. The asset was very attractive from a curb appeal standpoint, so we could get past the new supply concerns. $35 million valuation. That's $280 a door. A little better than what Beth said the average is, but this is a new property, new construction, Class A in a growing market. And then we built a leverage return model with a 15-year IRR, and that's indicative of value add to opportunistic returns that would be merited by a new construction lease-up play. So supporting precedent-setting transactions, comps for this asset support the value here on the high end. And I think we are going to open it up for Mr. Vickas here to have some Q&A. So don't roast us too hard, Vickas.
Yeah, we have about 15 minutes for questions. So I'll throw one out there to get started, and you guys can start thinking if you have any. The famous question, I know this was covered in different ways today, but where do you see cap rates today? Stabilized assets, SNF, separate for SNF, and senior housing. And I'd say, how do you see that changing in the short term, meaning next 6 months to a year?
I guess I'll start. So we see more often than not assets that may not have the income in place to apply a cap rate. So what does that mean? Like Alan said, you got to come up with a pro forma cap rate. So seniors deals, we're seeing a very big spread between some of the older vintage, potentially CapEx strapped assets that are fluctuating in terms of operating performance. So those compared to those Class A stabilized core assets, seeing a very wide disparity there of valuations. I'd say the tightest cap rates we see are right around that 6% still. And you haven't seen so much change or shift in the Class A seniors housing core high quality assets, but you have seen a pretty decent shift to the wider side on this B asset quality AL and IL properties. We're seeing those cap rates trade 7, 7.5, even 8. So big spread there. And then in terms of SNFs, again, based on forward-looking projections, we're seeing some volatility and some challenges facing the industry. So that would imply wider cap rates going from historicals 11, 12, 13. We would imply a larger cap rate there, wider cap rate there. But we're seeing a huge influx of private capital really offsetting that risk factor. And we're seeing cap rates kind of stay in that rate, 12 to 13 for SNFs right now.
So we're using pretty much down the fair, pretty similar to what you're saying. So 12.5 to 14 on SNFs. There's going to be outliers, higher margin SNFs. You can argue, should that have a higher or a lower cap rate because it's actually more at risk. So on senior housing, I agree with Ben also. I mean, the good stuff is probably 6, has a 6 handle, so 6 to 7. And by good, I mean relatively new construction, good operating fundamentals, and barrier to entry markets. The type of thing that Vickas would buy, or at least look at. And then really, we do see that bifurcation also. Older stuff, by saying older, I mean 20, 25-year-old product that is functional. I think those properties, I developed an AL memory care in Sarasota, Florida, and we've been surprised at the number of people that are moving to our facility from older facilities, and they're totally functional, but new seems to beat, I think as Steve Monroe said once, new beats location right now. So so we see those older facilities probably as the most at risk. And if you said a 6 to 7.5 for the institutional stuff, you could probably say 7.5 to 9 for the older. And I also see a lot of concern about freestanding memory care. Not a lot of concern, but I have some concern about that. Vickas, to your question of where do we see all of this going, I don't see cap rate compression continuing, and so the only question is not if but when. And I think operating fundamentals are going to trigger some increases in cap rates as pro formas aren't met just due to the influx so much supply. So I give that over the next probably 1 to 2 year kind of horizon that I think we'll see a shift, and that'll probably precipitate a slowdown in new development of senior housing.
So let me just add to that in terms of the vintage of the stock, so across the U.S. there's about 60% of the stock was built 17 years ago, so prior to the year 2000. So that's a lot, and there's only about 2 or 3% of the stock that's actually 2 years or younger. Mm-hmm. So there has been some new development, but relative to the age of the stock out there, it's still a pretty old vintage stock. Mm-hmm. And then in terms of changes in the markets, I mean, I showed you this chart on supply and demand, and we're at a point that occupancies are down, so that's a stressor compared to where we were 5 years ago. Mm-hmm. We have new competition coming in a number of markets, which is a stressor that we didn't have a number of years ago. And we have rising expense rates related to labor issues. So the sector's got a lot of opportunity, but there's more challenges. It takes a stronger operator today to be able to navigate through those challenges than it did, which can translate into valuation adjustments.
Yeah, it's a near-term perfect storm.
Yeah.
So from the audience, and we have a few NIC representatives with microphones that can help you. Feel free to ask a question to a certain speaker or for the group and just let us know. So, gentleman up there.
Have you seen portfolio premiums on the cap rate side reduce over the past couple years? And when I say portfolio, 25, 50, 75 assets plus.
In my opinion, yes. It ebbs and flows with the appetite of the purchasers. So when the REITs were very active in a very large way, I think portfolio premiums have spread. I still think that for a quality portfolio, there is a premium, but it's probably at the lower end. I think we typically see 0 to 150 basis points as kind of a range of portfolio premiums. So in the good times, maybe as high as 150. And I'm not talking nursing. That it seems to apply less to nursing. But I still think for the right asset pool, you would have that. But I just think we're kind of at the low end of that. I don't know, Den, if you're...
Yeah, I think I concur with Alan's assessment. I think the one thing I'd add, and we're looking at several large portfolios for certain customers we work with, but we're now really looking long and hard at the Goldilocks theory. And I don't know if you guys remember, I don't know who's got young kids, but the porridge is too hot or the porridge is too cold. So we've found that asset pricing and portfolio premiums really does have a diminishing return in our space, so that if your portfolio is too big, the curve, to use the economist's terminology, actually is inverted. So what does that mean? Why is that market behavior happening? Well, once you have a package, and I'm just going to throw a number out here, $500 million, the air starts to get too hot for some bidders, and a fewer amount of bidders implies lower marginal willingness to pay. Whereas you have many, many investors who are looking at $50 to $250 million packages who can figure out how to capitalize those acquisition opportunities, and there'll be 10 or 12 or 15 bidders on an offering in that space. So that space is just right.
And there aren't a lot of big portfolios out there right now that are being sold either, are there?
You always hear rumors of, you can take Brookhill as an example. There's always rumors of things, but until they happen, it's one thing to put it in play, and it's another thing to actually execute. I think the other thing is capital availability and balance sheet size. And I think, Ben's absolutely correct. When there is a disincentive, a disequilibrium as you get beyond a certain level, because some deals just can't get done right now at a certain size. So capital's not available.
How do you value operations only? If the real estate's not connected, but you have a portfolio of profitable operations, how have you done that in the past?
So like a leasehold interest valuation? Yeah, that's a really good question, because we get asked that all the time. I've got a leasehold interest. It's got 3 years remaining. What cap rate do I put on it? Well, you don't. If you have to have a multi-year leasehold interest, and then you take that income and you discount it back. So with zero reversion, typically depends upon the terms of the lease. If I'm answering your question right, I hate to do that, because really I would take, to me, to put a cap rate on a leasehold income stream, it would be a 20-25 year remaining, because really anything less than that, the cap rate's is going to exaggerate that, and so that's just our practice. And we'll use a discount rate depending upon the coverage of as low as 9 and as high as probably 12 on that income. And it all depends upon the lease coverage. And the higher the lease coverage, obviously, the more stability there's in the income stream.
So just as a follow-up, you've never done a multiple of the net profit on any of those, or the operating income? You've always done the cap rate approach?
Yeah, it's kind of one and the same. A multiple would be just a different way of using the cap rate, and that wouldn't work again on a leasehold just because of the. Now it could if it's a 25, and also if there's renewal options. So if it's a 5 years remaining, but you've got 2 10-year options, and the coverage is good, so the likelihood is that you would renew those. Then, and of course, the simplest thing I always do, and I learned this years ago, is what would I pay for it? And so it's one thing to hypothecate to sell something. It's another thing to put yourself in the shoes of a buyer. And market value is the nexus of those two perspectives. And so we have to basically kind of juxtapose the interests of the buyer and the seller.
Just looking at the cap rates up there, I noticed some strong deltas between using the historical and the pro forma numbers. And I look at one of those deals, I think it was like a 5 cap or something, but on the historical, and if you throw in the pro forma, it was a 6.5. Mm-hmm. And if it weren't for that pro forma, I would probably not hurdle that thing. So how do you guys look at the pro forma? How are you determining it? And how are you, because I've seen some deals in my experience in the industry that I go, that should have never happened. Mm-hmm. And maybe they rammed it through by having a pro forma that was overly generous. How do you look at that? How do you scrutinize the pro forma metrics, and how do you determine that? The
most important criteria we use is the appraisal fee. And
That's good. That's good. It was a similar joke.
I want to make sure everyone was still awake. No, we that's the hard part of it, because we can get a pro forma, and in the case of an annualized T8 to pro forma with like a 25% NOI jump, for what? For why? And a lot of times we just can't. Sometimes it's like we can do this. Is okay, we get that. But other times it's like, well, we're going to raise rates 15%, and we're going to limit our use of pool nursing. Well, how are you going to do that? Well, we're just going to do it. Well, and then it's like, that's great, but there's too many leaps of faith in there. And that's how we will, and if it's a layup, then we're happy to give credit for something that makes sense. But that to me is, again, you look at a buyer pool and you say, is a sophisticated buyer, knowledgeable, really going to buy into that? And if not, then we can't either, because that's not market value.
If it was so easy, then why wouldn't the current operator implement those measures? And
achieve the value.
Yeah, so I guess the things that we can defend, the assumptions we can defend in the marketplace in a pro forma, supported by benchmarking analysis. We do a lot of benchmarking at Blueprint. What are the peer set? What are they doing? What do their PPDs look like? We look at rent growth assumptions on the private pay side. Where could this market potentially go? Can you get aggressive on rate increases? That's always one that if it's supported with good data, you can get away with. There's several other factors, but it just really depends on what your P&Ls you're looking at trailing are doing, and then what the new buyer would step in day one and have moving forward. So that's how we apply those pro formas. And sometimes when you go really aggressive, you're not going to get the buyers in the market to respond favorably, and you're not going to get away with it. People are getting very sophisticated, and underwriting's tightening. So
it ebbs and flows. There's like an emotional component to it. And my feeling is we're starting to see operational fundamentals, occupancies, and then it'll be margins. We've got wage rate pressures and oversupply, and all these factors, and maybe interest rates are going to start to go up. You're going to see a cooling of the appetite for the asset class. Now, there's still going to be outliers that will command a premium, no matter what the market is, the market cycle. But those are outliers, and that's because they're huge barrier to entry, successful projects. But right now, if I put my thumb on the pulse, I'd say, if a 10 is when everyone thinks everything's wonderful, my gut is we're probably at about a 7 right now. Caution is starting to creep in, and I'm starting to hear it. It hasn't resulted in a slowdown yet, but but there is starting to be concern out there about the fundamentals.
How much influence do you place on the regulatory environment in a particular state when you do valuations?
Nursing homes obviously is very critical, and even in senior housing, take for example, North Carolina, assisted living is a certificate of need state for assisted living and memory care. So to that extent, that would change our cap rate perspective. It's the same with reimbursement in Illinois, say for a nursing home. We would be very cautious just because of their budget, and that's regulatory, but it's also state finance. So it really, we do pay attention. There are better states, bad states, whatever, depending upon the property type. I'm sure you.
Yeah, I think that it's the flavor of the day right now is really understanding what reimbursement on the SNF side will look like moving forward, and a lot of states right now are in flux. So some states are in hotter demand for investors, and some just aren't right now for the challenges they're facing. Mm-hmm. Illinois is a good example.
All right, then a round of applause for our speakers today. Thank you all.